You've also been warning about the slow growth in the United States, about productivity problems, and now you're introducing a new word to your diagnosis, stagflation.
No, that's not a new word. That's
we don't hear about it that much.
Well, it comes out of the 1970s. All the Keynesian models said it was impossible to have high unemployment and high inflation, or at least some partial unemployment. And in the 1970s, it did. And everyone scrambled for a new explanation, and that's where the term came from. And we look at the moment, it looks as though, obviously, we've got a stagnation throughout the developed world. I mean, the developed world is aging rapidly. And the ratio of entitlements, as we call them in the United States, and social benefits, which is what they call it elsewhere, as a percent of GDP, has been moving up. And the result of that is a crowding out across the board, virtually every developed country, in gross domestic savings, and that, with borrowing from abroad, finances all of capital investment.
Sure.
And capital investment is the key to output parameters.
Okay, folks, that was Alan Greenspan talking about the word that we haven't really spoken about since the late 1970s when I was a kid, and that was stagflation. And we've been hammering the table about stagnant growth with inflation for quite some time. That was going to be the threat to the overall markets. And now we have a former Federal Reserve chairman, and probably the brightest of the bunch, that finally stated the obvious to some that are really looking contrary at this market to what the other traders are believing. And what other traders are believing and the financial media elite are pontificating about is the fact that the U.S. economy is doing great. Everybody's got a job. The economy is robust, and nothing could be further from the truth. We had jobs data that was released on Friday that showed a surge in part-time employees. It's a structural change in the economy, because nobody wants to hire full-time employees anymore because of the damage done by Obamacare. So the market had expected an increase of 176,000 new jobs for September. The actual came out 156,000, and the unemployment rate ticked up higher to 5%. Average hourly earnings grew. The average hourly work week ticked up, but this has been going back and forth for quite some time. The average hourly work week has been basically net unchanged for a couple of years now. And when you take a look at the other economic data that was released during the week, you had construction spending, a big miss. The market had expected an increase. We got a negative number. The ISM manufacturing index, which was negative, a contractionary number, 49.4 the prior period, came out with a beat of 51.5 versus the expected 50.4. Now, any number 50 or below is a sign of contraction in the marketplace. We're only at 51.5. We're at stall speed. We're within the margin of error. And when you take a look at the economic data that's set to be released next week, you don't have much, but what you have can move the markets. The FOMC minutes from their September meeting, they'll be released. The PPI, the Producer Price Index, that's a measure of inflation at the producer level, retail sales, and the Michigan Sentiment Survey. So we do have economic data that is set to be released next week that can move the markets, no doubt about it. But the macro picture for the U.S. economy is negative. So for those who are believing that the Federal Reserve is going to be hiking rates anytime soon, they're out of their mind. Even John Hilsenrath with the Wall Street Journal, who's the mouthpiece for the Federal Reserve for the financial news media, he said that November was completely unlikely and December is looking more unlikely than ever before because of the economic data that's coming out. Now let's take a look at the U.S. dollar, which rallied last week but didn't have a clear breakout above this upper band of resistance on a closing basis. It was above it. Then the Friday economic data came out, the non-farm payrolls, and the dollar was hit and closed down below this upper band of resistance. Now, could it rally through it next week? Maybe. The Federal Reserve minutes can spike the dollar higher. We don't have a breakout yet on RSI. We have stabilization on the stochastics. No breakout yet above the highs last seen back on the week of September the 12th. And watch for a possible double top here and a lower high. I don't think the dollar is out of the woods just yet. The indicators are bullish, no doubt about it. Price was net bullish last week, but you did see some sellers move in because there's doubt. Remember the reason why the dollar rallied last week is because everybody believed that a Federal Reserve rate hike was in the cards for December, and they were even stating that the Federal Reserve may raise rates with a probability of 25% in November ahead of an election. Extremely unlikely. So why are we going over the U.S. dollar right now? The reason is because we're taking a look at, as contrarian plays, gold, silver, the gold mining names, which have been simply clubbed. And if you believe the narrative by the financial media that rates are going significantly higher, then you don't want to buy the gold mining names. You want to avoid them like a plague. But if you believe, as I do, that you have inflation on the march and that you have a Federal Reserve that is faced with hiking rates into a weakening economy, I don't think that's going to happen. And that sets the stage for, as Alan Greenspan just said, stagflation. He says it. And there are those with the theories that I subscribe to that believe that there is no way that the Federal Reserve is going to hike rates significantly anytime soon. Might they do a December rate hike? Sure. Let's make it a once-a-year event like Christmas or Hanukkah. Let's raise rates once a year. That's not going to hurt gold. It's not going to hurt silver. Remember what happened after the Federal Reserve raised rates last December. Yes, silver, gold took it on the chin, but they then rallied into the new year despite the fact that the Federal Reserve was promising to raise rates in 2016, which they never did. Now, when you take a look at the U.S. dollar on a daily chart, we had a bearish key reversal at resistance, no breakout last week. Might it do so next week? Sure. The dollar rallied. It was a strong week for the dollar. I'm not going to deny it. To deny it is to be delusional. Not going to do that. So as of right now, the path of least resistance remains higher for the dollar. You can see gold overlaid in black line chart here. The inverse correlation is undeniable. And if we see a breakout next week on the U.S. dollar, I would expect to see weaker prices for gold. So I'm not calling for a bottom right now in gold and the gold mining names and silver. What I'm calling for is for you to watch for a counter trend rally. I believe that rally will fail. I think that the pullback and any retest of the current lows or a breakdown below recent lows will be an opportunity to load up on gold and the gold mining names. Let's get to those charts because these are the charts that we'll be watching in the coming week and weeks. And folks, if I didn't introduce myself prior, this is Bob Desmond over at the Contrarian Trader, and welcome to Best Stock Charts. These are the stocks that we're watching as trades for the coming days and weeks. And I'll be going into these charts in greater detail either on the week ahead commentary, which will be segueing into immediately following this video with members. That's a premium service. So if you want to hear what my analysis is for the coming trading week, sign up for a 14-day free trial offer. Or if you want some trade tutorials and you want these videos in the future because you find value in them, enter your email address. We hate spam too. You will not be spammed. And these videos, along with a couple of tutorials, will be sent out to your email box. All right, so let's begin best stock charts off with gold, the GLD. No doubt about it, the damage that was done last week is going to take weeks to correct. But what we've done here, for all intents and purposes, is that we have done a round trip to pre-Brexit levels. And we are back inside of a prior trading range. If we break down below last week's lows of 118.42, we're going down to 115.20. I would not be an aggressive buyer at these levels. Let me repeat. Just because we bounced and we had a horrible week last week does not mean that the end is over for this breakdown on gold. When you take a look at the stochastics and you see both the fast and slow line trading down below the 50 level, that's a cause for concern. So the path of least resistance remains to the downside, no doubt about it. And if we get a rally, we'll get a rally up to the 122.50 level. I would fade that rally. Book your profits, move to the sideline, allow for the retest of whatever low we put in. If last week was the low, allow for GLD to pull back and retest that low or put in a higher low. If inevitably 115 is our low, fade the rally that we see prior to a retest of 115, then you get all in aggressive on the GLD. Now is not the time because last week we had institutional selling. But I think that what is going to happen here, daily chart, what I think is going to happen here is that you're going to get an aha moment. What does that mean? What that means is that you're going to see a lot of traders, and remember, a lot of hedge funds went into 2016 underweighted to gold. In fact, Goldman Sachs, after they upgraded it going into 2016, downgraded it, saying it was a short, and then they took that short call off the table and they said get long of gold because they were underweight. I think that a lot of funds are underweight, and when you hear economic data released last week, which continues the narrative by contrarians like me that there is no economic growth, and in fact, the Atlanta Federal Reserve, which only a month ago forecast 3.8% GDP once again, and it seems like a daily event now, once again ratcheted down GDP growth from 2.3 to 2.2. That's within the course of a month. So what the real GDP number is, no idea. They're not going to tell us until after the election because they want Hillary. So daily chart GLD bounced off of support, had a hollow candlestick. That's a sign of indecision. Does that mean that we are out of the woods, a sign of indecision off of support level? No, I think that we need to come back down and retest this support level. Could we gap higher? Sure. I don't think we're going to get through the 122 level unless, of course, Brexit issues really become a problem over the weekend and we have fear on Monday morning. We could have an event, whether it's out of China, whether it's out of the EU, whether it's in the Middle East with what's going on with the Russians right now. We're having some serious problems there. And if we have a miscommunication, a plane downing, a Russian plane or our plane, that's going to really ratchet up tensions, and that's going to send traders into safe havens. Gold is one of them. Silver is another. U.S. Treasuries and the U.S. dollar is another. So there are any number of flashpoints out there that can cause fear. Now that's speculation. Let's assume that there is no fear trade out there. How do you play it? You fade the rally, allow for a double bottom retest, then you get long using a stop loss right below the prior low. If this breaks 118, look for 115 as your next support level. Next chart up. Weekly chart silver broke down below the lower band of this bull flag formation. We closed at support last seen back in June pre-Brexit. Volume last week was very high. Daily chart of silver. We bounced very much as we did on gold. Exact same candlestick formation. Does that mean that we're out of the woods yet? No, it does not. We need to see a rally, then a pullback, a retest of support. Then we begin to load up on silver. Volume was strong on Friday. Other stocks that we're watching, PANW, Palo Alto Networks. Weekly chart, a beautiful breakout back in August, and ever since then it's been off to the races. Now we're nearing resistance at the 165.29 level. So there are sellers above, but I still think that we have more upside to go here, and members will be talking about getting long of PANW as a swing trade in the coming days because we are in a triangle formation. One of two things is going to happen. We're either going to break down or break out fairly soon. I think that the path of least resistance is up. Therefore, I believe that we are going to be getting long of PANW fairly soon. expect a rally. That assumes that the market does not break down. Now, speaking about a breakdown in the market, we are looking to short the market. I don't believe that we'll be shorting the market in advance of Election Day because I don't believe that they're going to allow the markets to correct prior to. Because again, the markets want Hillary because Hillary is more of the same. Now, when you take a look at the chart of the TZA, which puts you 3 times short of the Russell 2000, so it's very volatile, not for the faint of heart. You could see that we were in a trading range. We broke down below the lower band of support the week of September the 19th. We've been trading sideways ever since, unable to recapture prior support. What I'm looking for before I get long of the TZA is a breakout on price. We already have breakouts building on the Ultimate Oscillator, on Stoch RSI, on the stochastics, and even on RSI. All are putting in higher lows and breaking out, except for price. So price matters. The shares are under accumulation, as noted by these up volume bars, 2 weeks in a row. Now, what I'll caution here about with TZA is that if the Federal Reserve issues a dovish statement, one of these Fed governors, they don't shut up. They're always speaking every week. If they issue a dovish statement or, God forbid, they ever talk about a new QE program, you're going to see TZA get destroyed because the markets will rally. So we'll be watching the weekly chart for a breakout. When you take a look at the daily chart, we're at resistance, can't break through this let's call it $28 per share. Acting as resistance. The indicators all look good. I wouldn't be a bit surprised to see the shares move higher next week, but I don't believe that the Federal Reserve and Treasury are going to allow the markets to drop precipitously in advance of the elections. Because as goes the stock market, so goes the election. And if we see a bloodbath in advance of Election Day, it all but assures Trump a victory. Now, when you take a look at these line charts that I have overlaid here, in green you have the micro caps, in black you have the S&P 500. You can see both extremes of the spectrum, large cap and micro cap, are rolling over. TZA volume rose. The chart is looking good. Next chart up, BRZU. A daily chart rallied on Friday as expected because the US dollar was down. But what was unexpected, weekly chart, was that on a weekly basis, the dollar rallied, but so did the BRZU. That's not supposed to happen. They trade inversely of each other. So somebody's right, either the emerging market traders or FX traders. So we'll see who wins this one out in fairly short order. But the BRZU, of which we were long of, is poised to move higher once again, and we may be getting long fairly soon. Taking a look at a weekly chart of the emerging markets, EEM, they too rallied last week despite the fact that the US dollar was strong. That inverse correlation broke down last week. So again, somebody's wrong, either emerging market traders or FX traders, and we'll find out soon. It's going to be very, very interesting. Okay, our extreme oversold watch stocks, Buffalo Wild Wings, BWLD, RSI is at 18.27, very oversold, lots of resistance above. What a bloodbath last week. Volume is rising, so you have institutional distribution. Let's go to a weekly chart. Now, using a daily chart, I think that it's going to be fairly easy and very probable that we come down to the 133.34 level. If that breaks, we're going down to, at a bare minimum, 130.32, if not lower. So while the shares look oversold, and they are probably going lower. I would not buy these shares yet. Let's take a look at a monthly chart. Now, on a monthly basis, so far, and I know it's only the 8th of the month, and we have a lot of time to go before we close out the month, and anything could happen. We could have a bullish key reversal and rally higher for all I know, right? But the probability is that we're not. And what we have definitely done in October is that we have broken down below a critical support level because we have a head and shoulders setup formed. Left shoulder, head, right shoulder. Here's our neckline at 122.15. We have already broken down below an uptrend line which formed back in April. So the probability of us getting down to 122.25 is pretty good, especially if we break down below the 130 level. So on a macro picture, on a macro basis, the probability of lower lows and considerably lower lows for BWLD is very high. So any rally is to be sold because the path of least resistance on a macro basis has now changed to the downside. We're rolling over on Stokes, putting in lower lows. The RSI has been telling you for months, get out of this stock. And this is your opportunity. You know, many times I go over best stock charts for members and I point out where people should have gotten out when the market sent them signals. And it's usually when you have a lower low, like you had here, prior high 205, new lower high 172.91. And now we are breaking down below support levels, putting into jeopardy a prior support level at the 130 level. You get a breakdown below that level. That's a confirmed breakdown. So if you're in love with BWLD, don't be. Don't fall in love with this position because it's going lower. I beg of you. At least put on a hedge, buy puts, sell calls, whatever. Hedge yourself if you're not going to sell. So members, we'll be looking to get long. I know that sounds strange. We'll be looking to get long, although I'm quite bearish longer term on BWLD because this downtrend is unsustainable. We have known support levels which will be defended. We'll get counter trend rallies. Those counter trend rallies are to be sold, and then we'll look to get short longer term. Another consumer discretionary name, Tempur-Pedic, hammered, weekly chart. We haven't hit support yet, which is at, let's call it $51 per share. And that support level is critical because we formed a double bottom setup and it acted as a launching pad for this most recent setup. If we break down below $50.80 and close there on a weekly basis, it's all over for TPX for quite some time, and it is a short all day long. Would I short it now? No, I'm looking to buy it. Daily chart. Daily chart, we have RSI at 19.08. Oversold, yes, but not oversold enough. I think we're coming down to the $51 per share level. Then we'll look to get long of it. That assumes that this support level holds. If it breaks, which it could quite possibly well do, we'll have to come back to the weekly chart and say, okay, where might there be more support below? That's at the $49 per share level. Then after that, 48, and then more secure support at the $45 per share level because it acted as support back in February, and prior to that, it acted as resistance back in February of 14, and prior to that, it acted as resistance in 13. So Tempur-Pedic, I think we still have more downside before we get long. Any rally is to be sold, profits taken, then we look to short the name longer term. Lululemon, weekly chart, another consumer discretionary. Note how consumer discretionary is getting clubbed like a baby seal. According to the federal government, the economy is growing. We have robust job growth, but why aren't people spending? Why are consumer discretionary names getting clubbed? So Lululemon, daily chart, extreme oversold stock. We hit support on Friday. I went over this one last week on best stock charts. RSI is at 14.73. Members, we're going to be talking about Lululemon in greater detail on the week ahead commentary. We're going to segue into it immediately following best stock charts. If you're not currently a member, it's premium content, so just sign up for the 14-day free trial offer, and you'll hear our strategy session regarding Lululemon and another name, which we'll be going into greater detail on later on in best stock charts. So Lululemon is near a buy point. Volume was still above average on Friday. You could see that we bounced off of support last seen back in February of 16. All right, weekly chart. You could see that we bounced right off of support, but it was only a slight bounce. And last week they rallied it only to reverse it to close lower on the week. This is a bearish key reversal. So the probability of this support level breaking is fairly good. And if we break the support level, we're going to come down to probably $55 per share. So members, more to come on the week ahead commentary with regard to Lululemon. Our next chart up is ICU Medical Inc. This stock is in fuego. We have no historical resistance above, which is allowing for the stock just to simply rip through the roof. Now, when you take a look at the daily chart, we have RSI at 86.23. We have the shares trading up and above the 3 standard deviation Bollinger Band. Folks, this is not going to end well. When I speak to you next week on Best Stock Charts, I can assure you that by this time next week, we will have seen ICUI have a correction midweek next week. And it'll probably be a fairly ugly one. But right now, you have institutional support moving in, buying up shares. Now, members, we're going to drill down to intraday charts because we're probably going to get short of ICUI very early next week. Do I believe that it's going to zero? No. I just believe that the shares are at extreme overbought levels, nosebleed levels. This trajectory, this rally is unsustainable. Members, we're going to talk more about ICU Medical on the week ahead commentary. And in fact, we're going to segue into the week ahead commentary, starting with Market Pulse Check, which is where we review the health of the overall markets. And then we'll segue into our deep dives of watch stocks and then talk about our positions. All right, members, let's begin Market Pulse Check off with a weekly chart, 10-year yield. A very strong week last week, but we hit resistance at the 1.75 level and bounced off. What was the culprit for the pullback? Daily chart. The data on Friday, which was released, the non-farm payrolls, was bad. Besides the fact that we hit technical resistance at 1.75, we're very close to the 200-period moving average, which is declining, which is going to act as a declining ceiling. So I don't think that we're going to skyrocket through the 200-period moving average next week. Now, the only caveat to that is that